Hello everyone, welcome to our discussion for the cost concept. In this lecture video, we should be able to understand what is the definition of the cost and concept of the relevant range. Compare the various types of cost under the different perspective between accountants, managers, and economists. Illustrate the cost behavior of fixed and variable costs under or within the relevant range. To start, let us talk about cost concepts. Management accounting is about profit management. The endpoint of operating performance is to generate maximum profit out of the available resource for use. The use of the term cost here includes cost and expense. Managing costs means knowing their nature, behavior, and other characteristics. Let's talk about relevant range. The behavior of cost is predictable within a relevant range. A relevant range is a band of activity or stretch of activities where behavior of costs, expenses, and revenues is valid. In the short range, total cost, unit sales price, and variable cost rate are constant, while total variable cost changes in relation to the level of activity. Relevant range covers only a short range of activities. As the volume changes, the unit sales price, the variable cost rate, and the total fixed costs are held constant. Production equals sales, and in-process inventories and sales mix are always constant as well. Let's talk about the cost concept under the accountant's perspective. When we say capital expenditures, it investing outlays normally requiring large amount of funds and resources having a long-term impact to business profitability and growth. For operating expenditures, these are the expenditures or outlays or consumptions used to directly support the normal operating activities of the business. Now let's compare costs versus the expenses and losses. We can say that it is cost. Costs are traditionally classified in relation to the functional activities of the business, that is according to the place and purpose of their use. Expenses comprise all those charged against income in each business period, while losses are reduction in the value of assets without benefit to the business, leading to the impairment of equity, or in financial accounting and reporting subject, these are called impairment losses. Let's talk about product cost and period cost. Product costs are those incurred in the process of producing the product, while period costs are those incurred outside the production activities. Let us talk about the cost concept under manager's perspective. First, let's compare the relevant cost and irrelevant cost. Relevant costs have two characteristics. It should be differential and it should be in the future. While irrelevant costs, this pertains to past costs, sunk costs, and historical costs. Avoidable costs and unavoidable costs. Avoidable costs are those not incurred once an activity is not performed, while unavoidable costs remain to be incurred regardless of the option a manager chooses. Planned cost and actual cost. Planned costs relate to future occurrences, while actual costs are expenditures already incurred and recorded in the accounting books. Budgeted cost and standard cost. Budgeted costs are those expected to be incurred at the budgeted level of activity, while standard costs are those expected to be incurred at any level of activity aside from being used in the master budget. The following are the cost concepts under the economist's perspective. First, let's talk about the opportunity cost and imputed cost. It is an opportunity cost when it pertains to benefits given up in favor of another choice, while imputed costs are those not incurred but are implied in each decision. Incremental cost and marginal cost. Incremental costs represent a total increase in cost, while marginal cost is an increase in the cost per unit. Variable cost, fixed cost, and mixed cost. Variable costs are those changes in the total that are directly proportional to changes in the level of production and sales, but will be constant on a per unit basis. Fixed costs are those that remains constant in total, but inversely changes on a per unit basis in relation to the changes in the level of quantity, volume, or activity. Mixed costs are those costs containing both the fixed and variable components. Let us have this case fact for the cost sensitivity. Total fixed cost is 200,000, unit variable cost is 20 pesos. Then we have four different level of production or level of activities: 0, 5,000, 10,000, and 15,000. The first thing that we have to assume here is that the 0 to 15,000, these are all within the relevant range. For the total fixed cost and the unit variable cost, these two will be held constant within the relevant range. Meaning to say that regardless of the level of activity, for as long as that level of activity is within the relevant range, it means to say that the total fixed cost and the unit variable cost will remains the same. Unit variable cost 20 pesos, then the total fixed cost here will now be 200,000 pesos. 20 pesos multiplied by 5,000, you will get 100,000. 20 pesos multiplied by 10,000, 200,000. And 20 pesos multiplied by 15,000, you will get 300,000 pesos. Now let's try to solve for the unit fixed cost. If the total fixed cost will still be constant regardless of the level of production and if it's within the relevant range, so basically this will be your numerator, the total fixed cost divided by the production or the level of activity. Since we are talking about here fixed cost, regardless if there will be no production level, then fixed costs will always remains the same. If you're going to solve for 200,000 divided by zero production level, you will get an error. Since the 200,000 is considered to be as fixed cost, then that 200,000 will still going to be incurred regardless of the zero level of production or regardless if there will be no production at all. 200,000 divided by 5,000, you will going to get 40. 200,000 divided by 10,000, you will going to get 20. Then last one, 200,000 divided by 15,000, you're going to get 13.33. If you're going to go back to our definition for the fixed cost, the total fixed cost here is constant, but the unit fixed cost here will have an inverse relationship to the level of production. We can now complete the table. 0 total variable cost plus NA, you will going to get NA because NA stands for the error. So if you're going to add something from an error, then it will still be an error. Then unit variable cost, this is always 20. 20 plus 40, you will going to get 60 pesos. 20 plus 20, 40 pesos. Then last one, 20 plus 13.33, you're going to have 33.33 pesos. If you're going to solve for the total unit cost, then there is a variable and there is a fixed, then you're going to see that the level of production is increasing. We can now analyze that the total unit cost, if the level of production is increasing, then the total unit cost is decreasing. So likewise for the unit fixed cost. The reason for this one is that since the unit variable cost will be constant, then we're going to add another number that is decreasing if the level of production is increasing. That's why the total unit cost will be decreasing as well. Then we can now add up for the total cost. So 0 plus 200,000, you will going to get 200,000. 100,000 plus 200,000, 300,000, 200,000 plus 200,000, 400,000, and lastly, 300,000 plus 200,000, you're going to get 500,000 pesos. That's the end of our lecture discussion for the cost concept. Thank you all for watching.